Hey guys, welcome back to the Capital Mindset Show. I apologize for not posting a video yesterday. Yesterday was a very busy day. So you're getting a video today, and it's going to be a reaction video, one that was requested on this one in particular. And I also think it's pertinent based on the times we're living in, and all utmost respect for Sven, I think, as a creator. So definitely one of the much better creators here on YouTube. So I'll just leave off with that. So this is kind of like going to hopefully bring about friendly discourse, friendly discussion. And I also have kind of been meaning to do a macroeconomic video because I get that question a lot, like when are you going to do macroeconomic videos? So if you checked out my live stream, I did have a little bit of a quote unquote speech, you could say. I do have calls on the Discord that I do talk about these things here and there, but this is a video dedicated, and I think the feedback back and forth, well, it's not really back and forth, but I would love to have it back and forth with Sven, or pretty much. Well, I'm kind of an economics nerd anyway, so with anyone really. So we're gonna have a little bit of a talk here, and we're gonna watch this video, but also with the context, I'm gonna be coming in here and there and actually sharing some data points that I have talked about or have dropped in the past, but of course the channel was much smaller back then, and some interesting tidbits here and there.
Last week we discussed the stock market crash, and I asked you whether you want me to make a video on some topics that go beyond everything: demographics, fiscal debt, productivity,
government debt. Here we go.
So if you look at the federal debt, this is for the United States, it is up 6 times over 20 years. So 6 times over 20 years, 6 times. That is insane, and nobody cares about it. However, as interest rates go up, there will be a...
Okay, so I like his point here that he brings about debt, right? So we see debt levels rising since the 1970s. I have to also kind of bring about this thing that we have talked about in the past. So United States has shifted from a commodity-based monetary system to a debt-based monetary system. So, of course, during a debt-based monetary system, the primary factor, the primary driver of the flow of money will be debt, okay? And that's actually, in essence, what drives everything. So the dollar, I don't have a dollar on me, but the dollar bill itself is a representation of that debt. And in fact, you could say that a dollar is a non-interest bearing note, which it is. That's what it is. They're Federal Reserve notes, the non-interest bearing note. And then you have bills or treasuries, let's just put the whole debt of treasuries. They are interest-bearing dollars or interest-bearing notes, okay? So with that being said, I just want to state one other thing to say is, well, it was bad, but one thing you want to pay attention to is relative that debt growth to the GDP growth. And we're going to start quoting some other research that we're going to bring about as we go throughout this video, but I want to hear Sven's points here first.
A big difference in financing that debt. The cost of debt goes higher. For example, 29 trillion with 1%, the cost is 290 million. Now that's the cost, and nobody cares about the debt because it's cheap. It's free money, so free money, who cares? The Fed is buying it, the Fed is printing, so it's just refinancing that, so nobody cares. But if interest rates go to 5%, then the cost of the debt is 5 times higher, and then suddenly it starts to matter. If we just look, let's say the cost of debt, 300 million, 400, so the net interest here is really, really low. But if interest rates go higher, then the net interest will, let's say, also take other spending, and that's already there.
So I've already been kind of on record. So I created like a little model for it, and basically, just to spoil it out, basically based on trajectory, it's not really going to be that much of a problem under current estimations if things kind of remain the same until about 2040, 2030. So quite some time in the first place. And that's all else being equal. So that's the problem with something like that, a projection that far out into the future. All else being equal, that's the case. Now he's making a good point here. Yeah, interest for on the notes per se that the government is borrowing. By the way, the government borrows mainly on the short term. Many people don't know that, but there's actually reasons as to why, and we're going to that's getting really deep into it, but the plumbing of the financial system requires that the government actually issues more and more debt because of what is known as pristine collateral. So remember that word for those of you who are new to this. Pristine collateral. What is pristine collateral? Well, treasuries. We talked about this, and every time we talk about banks or the commercial banks, the primary dealers, what it is that they're doing, what are they buying, why are they buying it, why is their behavior so unique or interesting when they seem to be rejecting other forms of debt or lending and they prefer treasuries. It's kind of a voting with your dollars method, but we'll get to that.
Then 20-something% of the federal budget, and that becomes totally unsustainable. Plus, the projections are that they will keep being in deficits, keep increasing their debt by 4 or 5% per year constantly, and then later, where all the obligations, Medicare and all that starts kicking in, then even more and more. And like everyone is happy buying that debt. However, yes, they're happy with higher interest rates, and that's something that this is impossible. So economic growth should be exploding to keep debt to GDP at levels. But this is a concern. Maybe we'll talk about next year. For now, nobody cares because still interest rates are low and only now are starting to take shape higher, but still very low and not an issue for the government. But yes, it was easy to borrow with lower and lower interest rates. You're stupid if you don't borrow. But now, if you don't pay back, as nobody does with governments, then it becomes an issue. But that's the US. Let's talk about Italy. 2 trillion GDP, debt 134.8% of GDP. So that's what, 2.6 trillion of debt. If we look at the interest rates in Italy, those are really, really low, ridiculously low still in Europe. Now those are going higher as they have to given the Fed hikes. But keep in mind the debt and what happens if the yield goes back to 6% when Italy was supposed to go.
So yeah, Italy is in a different peculiar situation that I want to actually highlight. So the United States currently holds the world reserve currency status. So I just want to also state everything I do say in terms of bringing other points to the table actually relies on it. And in fact, that if United States were to somehow lose reserve currency status, which I don't want to get into, but that's actually the real economic war that China consistently plays with the United States, because they don't actually have to defeat the United States with firing a single bullet, but we're not getting into that. We're just sticking to this. So Italy, comparing Italy to the United States is kind of two things that I wouldn't really put in the same table, because Italy doesn't even control its own currency. Well, if we're getting really right down to it, the United States doesn't necessarily either, because part of the Eurodollar system. But the Italy itself, and we'll put that to the side because that's Jeff Snyder's work. But Italy itself is part of the Eurozone, so they don't even have, for example, the lira, which was the old currency of Italy. They don't create it. And I'm using that word very loosely because, as you guys might know as fans of the show, or maybe you guys are new, here you go, here you're going to hear this tidbit. The United States does not print money. And I already heard Sven kind of say print money several times before, so he's going to say it again in this video. But no, the United States does not print money. We're going to get into that because I get questions here and there. Also, if you have any questions, please join me for the live stream tonight. I will be having a live stream. Or if you see this video too late, join me on the next live stream and you can actually ask the questions there if you have any questions. Of course, if it's a very long question and answer, I might reframe it and make it into a video, maybe. But keep that in mind. All right, so just there.
Bankrupt 10 years ago. Well, Italy goes bankrupt if the ECB doesn't print more money.
And they don't print money, they take on debt. So if I'll just kind of do a quick thought experiment. If, for example, the money was actually printed, absolutely, yes, they would have caused hyperinflation. But you didn't experience hyperinflation. Hyperinflation is not occurring. In fact, the massive majority of the inflation is actually because of supply chain constraints and because of fiscal spending. Fiscal spending can be extraordinarily inflationary, as we'll get to into why, but the debt portion, not so much. The debt portion is actually a bit of a reversal problem. And printing, we can't really say that. What they're printing is reserves, okay? And then we're going to get to the technicals as to what the heck are reserves, why is reserves not money, but we'll get there.
Completely destroy the euro. So the issues will arise, and that will be something we'll talk somewhere down the road as interest rates go higher to curb inflation. So it will be certainly interesting, but this is an issue much more important than current rates, I think. However, nobody likes to talk about it because it's not important now. Suddenly, like it was with inflation, when we all knew it would come, suddenly it becomes a hot topic. And that's the same for this. It will become a hot topic. And then, again, a fact,
kind of like
as you're watching this video, I hope you're getting a little bit wiser, but the fact is, the certain fact is that we are both getting older. And there's nothing we can do about it. So if we look at the demographics, stability for Europe in this case, but then down, 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 with higher debts and less people, that's again something that doesn't really work. Also, growth in working age population in the US, the slowest ever projected, and only immigrants are going to increase the working age population, which again leads to less workers. Who is going to service that debt? We are older, thus also less productive as a country. I
just want to be very clear also, because I think I don't want everyone to not think this. I'm not saying the debt's not a problem. I'm just saying the consequences of that debt will be a little bit different from what most people think, or at least its effects having on the market. So, but yeah.
As the developed world. If we look at the trend growth of GDP, okay, 2%, but still just 2% and likely to be lower and slower over the long term. And we already see here a decline. So if there is another quarter like this, that's a recession for the US. And yes, everyone is saying the US consumer is that strong. We are so strong. The consumer has money. But that might also revert.
Okay, so one thing I also want to state, because he's showing GDP here on the right. So GDP, for those of you who didn't know, the formula is pretty simple. So you add investment, you add government spending, you add the delta between exports and imports, and you also add consumption. So the United States is primarily consumption, and then government spending is smaller. In some countries, government spending will be larger, and there's going to be a difference in fluctuation. So when you see, you see net exports, you might not see it there, but I'll move. Net exports is down there at the bottom, and so you would add that. That's what the delta between imports and exports, so net exports. And net exports is negative 4.8% because the United States has a deficit. A massive amount of consumption, so the U.S. consumer is pretty much the economy. But we'll get to that government part, because the government part's a little bit of a problem, as we'll see with data.
And there we'll have a recession, and then also you never know when will that recession end, whether the Fed will print more or who knows what. Productivity, if you look at this, labor productivity has been flat in developed countries for the last 20 years. So that's bad, and therefore it's really, really hard to sustain what has been going on. And that leads into populism and into the long-term debt cycle.
So I just want to see this. So this is, this absolutely is a bit of a problem that we are observing. So absolutely, yes. No bueno.
Sustain into the long-term debt cycle, which we are in the final innings of. Wish it or not. Whenever something bad happens, the Fed prints money, prints money. If we have a recession, higher unemployment, what will the Fed, what will politicians force the Fed to do? Well, of course, they will print money. There is no other option. Once you're higher printing money, you keep it until you can do it. But this is really typical for the long-term debt cycle. Again, a topic that people will start talking about in the next decade. And you have the long-term debt cycle, so everything starts off productivity. This is the productivity line. You can increase the well-being, as we have had great 20, 40 years in the of economy, of growth, of everything, of life, by increasing leverage, okay? You can have great times, but then at some point the long-term debt cycle is over. You can't borrow more, you can't print more without having a negative impact on the economy. Inflation, stagflation, sooner or later, ding, 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 ding. And then it gets to a depression, refinancing, whatever, and then you start catching up again with the productivity. So this 2 years depression can happen and will likely be a bigger issue than the current small hikes from the Fed. When will this happen? Can happen tomorrow, can happen in 2030. Nobody knows, but it will likely happen. So keep in mind, we're also in a big paradigm shift. We have had 40 years of declining rates.
This makes me feel like he's kind of referencing all Ray Dalio. I don't really know if he is, but yeah.
40 years of increasing asset prices. Stocks can only go up. 40 years of good economic growth. In summary, 40 years of great. And the fact is that the last 10 years have been based on leverage and money printing, and now we are paying the consequences for that. And now, this is a very important thing. We don't know whether zero interest rates for a decade have been worse than hiking in 2011. So that's something we will never know. So we cannot say, oh, we had to hike rates in 2009, 2010 and stick to that, because that might have led to 10 years of depressions while we had 10 years of partying. But
all right, so I'm gonna stop him there because I think now from here, well, let me
sooner or later.
I guess I'm not gonna put in a good photo. Dang it. All right, much better. So that's Suave Sven. Suave Sven is going to be there. Okay, so basically I'm going to start. I just wanted to make sure his face wasn't paused in a bad way that made him look bad. So we just have Suave Sven here. I hope that's like a, how do you say, a good image. Okay, so anyways, I want to actually discuss some other key details. So like I said, I don't think that the debt's not a problem. I don't hold that view at all. I hope no one actually comes out of this thinking, oh, Fabio says that the debt's not a problem. No. I think that the problem is different in nature. So the first one that I want to show is this one. So marginal revenue product of debt. So what he was discussing, we can actually see here. So this is actually showing us the actual velocity of money or the amount of return that we got. I kind of got a slip there because I'm going to talk about the velocity right here. So from 1950 to 1990, you see that it was rather stable, and that's because we had a rather stable amount of debt versus the growth of the economy. So the stability was pretty interesting or pretty good. And the domestic non-financial debt was still there. When we talk about Dr. Lacey Hunt's work, I actually want to start to point out that government debt / government spending is actually a negative multiplier to the economy or to economic growth. And when you break it down, it does actually make sense. So for example, let's think of what profit is for a moment in time. All right. So when you think about profit is a measure. It's a mathematical measure. But what does it measure? Well, it measures the money in excess of the expenditure. What is money? We talked about this in a previous video, a long time ago now. But money is a representative of resources, of energy, of whatever it is you want to call it. But money is a representation. It's a tool. We use it to represent value. Value of what? Value of resources. So we can expense and get resources, and then we use currency, we use money as that representative. So profit, by extension of that, is a measure of efficient use of resources. When you profit or when you expense less than what you bring in, you are being efficient, okay? And then you take that profit and then you go out expense resources, and then basically you as a cog in the proverbial machine, you go out and you vote with your dollars on what it is, and we call this aggregate demand as a conjunction of all of those consumers together. Okay, and so debt is a form of leverage. So marginal revenue product of debt, we do see it declining over time. So what is this telling us? Well, the return multiplier of debt is declining. It was already not that good, but it was getting worse. It's getting worse and worse and worse and worse, okay, over time. And then we see total debt and domestic non-financial debt. Okay, it's getting worse and worse and worse over time. And it's only getting worse actually from here. So I'm going to pull up another thing for us. So looking at this is similar to what he showed you in the video, but this is a different look on it. And this is real per capita GDP. Why are we using per capita? Because economies, they can vary in size because of also population size. So consumers have demands, and they actually kind of have a huge effect on the overall size of the economy. So we look at it per capita to try to measure on a per person basis. Now we are this is since 2019, by the way, we are about 17.1% below trend, okay, in 2019. That's that measure there. And so This is not good. This is basically what real per capita GDP trend before or prior was about 2.2%. So you model that out into the future, and then you see what actually occurred real, by the way. So that's after accounting for inflation or measured inflation. You are 17.1% lower than what you otherwise should be. And this is when I did this video way back when, I asked everyone in the audience, I said, how do you define wealth? And there was a particular reason. I didn't really get into it, but basically what we can measure with this is kind of almost like arguably the person, the people, right, within the United States, within the developed world, are becoming poorer, and people don't really understand why, right? And poor is a relative statement, right? We want to say that, you are richer in terms of the ability to get resources. So technology has helped us tremendously in this effort. But in terms of a measure using something like real per capita GDP, maybe you want to use the Gini coefficient instead. We are not in a good place comparatively. Now, kind of moving on, I also want to show diminishing returns from debt, right? So this is, again, echoing back that previous statement, but looking at other economies. So Europe is even a worse place than the United States, and Japan is even a worse place. So debt in the beginning can be very effective, right? It can spur growth in whatever category because you're taking on leverage. And so previous knowledge, previous economic theory stated that government debt can be a boost because, it's like a household. You can take on debt and then you can spend the money. But what does the money imply? Going back to that statement about profit, well, profit is a measure of efficiency. And profit motives are also kind of a measure to try to be efficient. And efficiencies are good, deficiencies are bad, or inefficiencies are bad. And government spending is not efficient because there is no motive for profit. There is no motive for efficiency. Those things go hand in hand. And what is the problem when we have inefficient spending? Well, when we have inefficient spending, we have what is called malinvestment. Now, malinvestment is something that is very difficult to measure its effect on the overall economy. For example, a form of malinvestment can be we grab all the money, or the government just starts buying up, let's say oil. Just buys up all of the oil possible, all of it, just for whatever reason it decides. And the market desires it, right, for its various use cases. And the government just takes it and stores it in a hole, okay? Let's pretend that it does this, okay? It buys up all the oil and does that. Well, what are the effects that it will have on the economy? Well, we can kind of think of, in theory, what it will do, but measuring it in the present moment in time can be actually quite difficult, more than you think, and then kind of extrapolate from that and take it to many facets of the economy, and then you can kind of get why it is difficult to actually measure malinvestment. Now, what we measure, or how we measure malinvestment in reality, is one way of doing it is just waiting to see what happens, right? But that's kind of a sad thing, to wait and see what happens, and then when the malinvestment kind of turns its ugly head and you see the results of it, you're not in a happy moment, right? That's not a good time to be in. So government, by definition of its expenditure, is not efficient. It actually produces malinvestment quite often, either through the forms of either legislation or spending itself. And that's why I say physical spending can be quite inflationary. I hope everyone can kind of see that. And that's why I state it wasn't QE. Isolate QE from the table, cut it from the argument, put it to the side. What I'm stating is the rest of it, yes, was inflationary. So government actually taking the money and then going out and spending it, that can be inflationary due to the directional spending of that money. Okay, that actually can be. Now, QE as an isolation is just an accounting trick that the Federal Reserve does. It's just moving or classifying differently a certain asset or liability. That's all that's really happening. No money is actually being printed. I want to actually run by that thought experiment one more time. And maybe Sven Carlin is saying money printing, by the way, to kind of appeal to the lower common denominator. And I mean that in a respectful way, by the way. Audience on YouTube that is newer. So they don't quite want to talk about the nuances, so it's easier just to call it money printing. And I agree with that. It is way easier just to say it's money printing. M2 money supply is going up. It's money printing. Well, I'll tell you right now, if it was money printing, we would probably see a greater sum of inflation far beyond what you thought. So let's say the argument, let's say 50% of all dollars was created in X amount of time. Did you see 50% inflation throughout that time? Not really, right? A lot of other factors are dependent on that, right? We talked about a little bit velocity. We also want to talk about the nature, the nuances of where that money goes. And in fact, a lot of money is getting trapped, which is a bit of a problem, and the government doesn't really know. Well, the current present system doesn't know what to do with it. Now, if they change the system, throw away everything I'm saying. if they change the current system, everything I'm saying is quite literally garbage, or at least yesterday's news. So right now, you cannot go out and spend reserves, right? You can spend bank reserves, but you can't spend Federal Reserves, all right, or Federal Reserve assets. You can't do that. I actually bet you can't do that. You want to make this bet? We can make this bet. You cannot spend Federal Reserve assets on the open market. You just can't. And that's actually what the Federal Reserve can print. The Federal Reserve can quite literally only print that. If they turn that into currency, then you're going to have hyperinflation. And that's actually, Dr. Lacey Hunt addresses that. He says, if that were to occur, you would have the hyperinflationary collapse that a lot of people talk about, which this is kind of a part 1 reaction video. I think tomorrow or sometime this week, I'm going to do a part 2 reaction video to a debate between Peter Schiff and Ross Gerber. And I have a lot to say about that, I guess. But regardless, money, in essence, you spend either currency, right, your dollars, let's keep it simple, your dollars, or you spend bank reserves. Bank reserves, think of like your checking account. That's a bank reserve. You can go swipe your debit card, you can swipe your credit card, and you can pay the credit card with the money in your checking account. That's bank reserves. When you transfer money from one bank to another, that's bank reserves. That's not Federal Reserve notes. Or, sorry, not Federal Reserve notes. That's not a Federal Reserve asset, okay, to be particular. Federal Reserve asset. You cannot spend those. And that's what the Federal Reserve actually prints and gives it to the banks. And the banks send it to each other, okay, but not to you. You don't do anything with it, okay? Anyways, we're getting into this other stuff. So ratio of real GDP per capita, US, Euro area, US, Japan. So we can actually see what happens in the earlier time period to what happens today. Okay, so US was 77% lower than Japan in 1995 and 23% higher than in 1995 than Europe. Okay, guess what happened after that? It got worse. So it got way worse. So Japan was better than the United States, and then it got poorer relative to the United States, and then Europe was poorer than the United States, and it got even poorer. I kind of implore you, have any of you guys been to Europe recently? I've been to Europe recently. You really do feel, as an American, you really do feel the wealth difference between you and the average European. So you go out and you spend, it's quite drastic, depending on what country you're in, of course, because some countries are worse than others. I might be talking more particularly on my experiences in both Spain and Italy, as well as parts of France. So Germany, still a little bit better there, but, or, go to Greece, guys. It's incredible. Your money will actually go a long way. You can eat like a king there. So I'm talking for you Americans out there. And for you Europeans, you guys can probably attest to this. At least, all of my family that's still in Europe is all kind of can attest to this as well. We have these discussions every time we go over there. But anyways, that's kind of what the data is showing here. And what they have in common is that the amount of debt levels that they've actually risen has actually caused that. And actually it hasn't caused a hyperinflationary event. We see this massive amount of inflation, and it's not massive, but it's there. If you want to talk about inflation, talk about Venezuela. Venezuela, we actually did print money. You guys, and when I say you guys, I mean the Eurozone, Japan, United States. And by the way, you wonder, Japan, what's their system like? Well, Japan was set up to be a system, like a copycat system of the United States. So they have the same system. Most of the modern economies all have the same system. So it's regularly, or rather easy to kind of make the same equalized assumption among all of them. Venezuela had a different system. We quite literally, and I say quite literally, printed the money. And so we had a hyperinflation. You guys will not have hyperinflation because you're not printing the money yet. However, if you change the way the system works, everything I'm saying is old school, it's old news, and you will have hyperinflation. All right, but just not now. All right, so velocity of money, we do see velocity of money declining. Like, we want to say that it's also about money supply and velocity of money. And who actually does print money, by the way, is the banks. And I've been saying that every time we talk about banks, as much as I get to, but this video is getting into the meat and potatoes, so I have no qualms with showing no mercy to you by getting into the meat and potatoes here. Banks print money, not the Fed. Okay, the Fed prints Federal Reserve notes. And I'm just repeating information, again, just to kind of refresh things. Now, velocity of money, we do see, again, declining. I also want to state there's a common misconception that in World War II, we had this massive, exuberant spending, right? And in fact, it was a moment of austerity, because if you looked at private sector savings, it actually made up more than the deficit in the public sector. So technically speaking, by the way, because people usually like to cite the figures in World War II as saying, well, there was not austerity there and that's what got us out. No, technically speaking, there was actually austerity when you accounted for the private balance sheet. And then when we get back to the theoretical, right, or not the theoretical, but with the findings of people like Dr. Lacey Hunt and others, many others who've contributed to the work of economics, government spending or government debt, in essence, is actually a negative multiplier, but private is is a positive multiplier. And then again, we take a step back from that. Well, why is that? Well, then it starts to make sense when we think of the incentive structure. I'll quote Charlie Munger here, show me the incentives, I'll show you the outcome. If there is no incentive for a profit, and remember, profit is a mathematical measure of efficiency in this instance for resources, in that case, we can then conclude or understand why it is that government spending is a negative multiplier, okay? And then we call that, or we can call that here, malinvestment. And malinvestment is a very, very big problem, okay? So I just want to just show you this. Velocity of money is, yes, it is down. All right, money multiplier. So the money multiplier also, same story here. It's been coming down. So now it's averaged out about just under 4 at the last time of this measure in 2021. And then you can kind of see exactly what we were talking about before. So before you had a steady rise, and this was good. The United States was booming, growing out of the 1950s. And all of those, by the way, indicate recessions. So you can kind of see the drastic change. And this is now we're bringing in Jeff Snyder. So Jeff Snyder calls the past decade or the past almost 20 years as actually the silent depression. He calls this a silent depression. Now, why does he call this a silent depression? Well, he says that there's a problem here. There's a problem here that is not being talked about often, right? We had this massive crash in '08, and ever since then, it's never recovered. It's just not recovered. Something's wrong. Something's definitely wrong with the system. And where he points to, and I completely agree with him based on what I see within the banking system, it's in the banking system. The banking system has been, for all intents and purposes, shattered to some degree within the United States. And you can kind of think of it as such. So the banking system, there was legislation that goes back all the way till 1996, right around this here. Well, you can't see my mouse, but look at 1996. Legislation back in 1996 that we can actually directly point to as one of the prime contributors to the '08 crisis, okay? And then that was changing how banks behaved around there. All right, we won't get into that in particular, but just to kind of discuss after the fact, then banks started to, we looked at banks actually. Let me kind of say this first. We looked at banks to see, well, where are you putting your money? Who are you lending to? And you know, I can hear a bank CEO, and actually Bank of America CEO just came out today, and today is 5/24/2022. He came out today and said the consumer is really strong. I don't care what the bank CEO says verbally. I look at to see what the banks are doing in terms of their lending book. And it turns out that the larger banks, the biggest banks, they're not desiring to lend to, you know, your mom and pops. They're not desiring to lend to the average person, the lower quality credit ratings. Well, why is that? Well, it's almost as if they don't really think things are going to be good, and they think the risk profile is pretty high. That's what it seems like. And we talked about this with Ally Bank back in the last live stream. We talked about Ally Bank and how loans like that are kind of moving downstream because the larger banks, they just don't care. They don't want to deal with that. They're buying treasuries. And a lot of people might say, why are they buying treasuries? Well, then we get into like why banks, you know, they don't really care too much about the yield per se. There's other factors that are more of a primary reason as to why a bank would put their money there. But in all intents and purposes, I hope this practice explanation is better now. But let's pretend for a second that you loan me $10 million and I have to give you in 10 years that $10 million back. So my prime directive is to secure and make sure I have $10 million to give you because you're my liability. My liability to you is a $10 million. So I have before me a couple options. One that, you know, can generate, let's say 5% and has some risk of default. And if that defaults, well, I still have to give you your 10 million. Otherwise, I have to take it from somewhere else, or, you know, I'm basically going out of business. But let's say I want to stay in business. And then I have another loan that yields 1%. All right. So this 1% loan, the delta is 4%. But this 1% is pretty much guaranteed, albeit with the system entirely collapsing if this one doesn't pay me back. This is the government. All right. So then I'm rather going to buy that one. And we're kind of saying all else being equal on timeframes, by the way, all else being equal in timeframes. I'm going to take that one every single day because I don't care necessarily about the percent, really. Of course, if I could get the same guarantee at 5%, oh, I'm happy still. But let's say I have that guarantee at 1%. I'll take that 1% every single day. It's not my money. It's your money. I'm just making a cutoff of your money while it's in the bank. Okay. And then I can have that liability secured and I can just pass it on to you. So there goes then the count or the talk about, well, what happens in QE, which we'll get to, but put a pin on that. All right. So just wanted to show you guys this. Also want to show you the money stock. We won't spend too much time here, but just note that money stock annual change. It's been pretty high. Here's the M2 velocity of the 4 major economies, US, Euro area, and Japan and China. You can see the same story happening. Now, what do you notice about China? Okay, so China is far worse than something like Japan. Well, that's actually getting to some more technicalities. Japan and China are actually quite similar in that respect. They just have so many people. All right, they just have so many people. They just have a very bad financial system. Very bad financial system. In Europe, it's really bad. It's looking really bad. United States, though, is catching up. It's almost like we're going to say, not hold my beer. Actually, Europe is saying hold my beer right now to everyone. Japan, well, actually, no. Let me be very frank. Japan was the one who said, hold my beer, and I'll show you what's going on. I'll slow down faster than everyone. So supply side recession shifts aggregate supply curve inward, right? So what this basically is showing you is what happens with the supply chain disruptions. Price should go up. Quantity demanded should go down. We are seeing that. We are definitely seeing that. And it's not because of quote unquote money printing, right? Money was borrowed. Money was spent. Malinvestment did occur. That is also inflationary, okay? That can drive the demand curve up in certain key categories, okay? And then that can reflect itself in various ways into the macro supply-demand equation. But let's focus, like, for example, on micro. So we had stimulus checks. I'll tell you on a particular type of product. We had jet skis and boats. The amount of jet skis that were going for crazy prices was absolutely insane. And you could see that stimulus checks definitely did have a role to play. Stimulus checks had a role to play. And in fact, in the subprime lending category, we saw a massive amount of lending growth. Okay, this happened in the subprime. There's a problem with the subprime. We'll get to that in just a second. But in the subprime category, we had a massive amount of lending growth. We also saw a massive amount of spending, right? And we saw a massive amount of spending, physical spending from the government and giving all this money to people, which then went out and spent it. So in the microeconomic sense, you saw different sectors of the economy or specific products in the economy. The demand curve was shifting. It was shifting to the right. Okay, it was growing. And then supply, in some instances, was actually declining because of supply chain disruptions. So you had a crazy amount of price increases in, for example, let's say used car market. So the used car market, if such a scenario were to play out, you would expect to see a massive price increase in the used car market. But let's say if prices or if the money was actually printed, what would you have seen? Well, you would have seen an actual shift in inflation in conjunction with the amount of money that was created. Well, in reality, what occurs is the government borrows the money, and then the government with that debt, right? We do have a debt equation, which we'll get to in just a second. The government goes out and puts that money where it believes it's best. It has no profit motive, so it has no motive of efficiency. So in that instance, we create malinvestment in various sectors that will show up later, right? But we can't measure that right now, and so people usually, and this is where I absolutely agree with Sven Carlin, no one's going to talk about it until it shows up, right? Sometimes malinvestment takes decades to show up. Well, I'll say decades is maybe a harsh term, or harsh length, but let's say, 5 to 10 years. 5 to 10 years, sometimes that's how long it takes for malinvestment to really show up. And depending on the size of that malinvestment, it will depend on the severity. And malinvestment, again, can occur through legislation, or it can occur through physical spending. In essence, malinvestment is any time there's a direction of resources being spent in a place where there really shouldn't be. And again, market forces don't really allow for malinvestment, or they at least punish malinvestment severely because they don't allow for the profit incentive or the profit motive to be there. Okay, so malinvestment, and again, we measure malinvestment to the accordance of the consumer, how the consumer, where they desire things to go. So you and I together, all together as the people, we actually decide where resources are spent, all right, through our demand. Okay, we are the demand that the producers are willing to supply. Okay, they are the suppliers, we are the demanders or the consumers. We shift where resources go unless there's something tipping a scale, right? And in that sense, you can have malinvestment. So I want to say that, or be very clear, malinvestment can be legislative as well. Okay, it's just at any point where resources are being spent where they shouldn't be. And then the measure or the consequence of that, we'll see that later. All right, so moving on from here. So So in fact, this part, which I'll discuss now we've talked about everything. He showed this chart here, which is the long-term debt cycle, right? That's the Ray Dalio thing. Well, the problem is we have to separate the private debt from the public debt, right? Public debt is going to behave a little bit differently, as we've just been discussing. So when the government, issues debt, right, we have the debt equation, which I said I'll talk about, so I'm talking about it here. So we have the debt equation. So you think that we're printing money. No, you're not. What is happening is you create the asset, and then you also create the negative, the liability, which is the implications are that you pay off the liability. Of course, let's say the government defaults. If the government were to default, yeah, you'd probably see a hyperinflationary crash. Okay, let me just say that. But let's say not hypothetically, in this scenario, the government doesn't default. If the government does not default, then in that sense, you have 1 minus 1 equals 0. All else being equal, we're ignoring interest rates. Okay, we're ignoring the interest component, but the interest component adds a little bit of extra flavor. Okay, so the interest component, who's buying all this debt? Well, we also want to talk about the dollar rising, okay, because the dollar has been rising, and some people are like, well, why is the dollar rising? And this was a question brought up in the live stream. Well, the dollar's rising because everywhere else is kind of bad right now. Okay, and so money is kind of plowing into the safety, which is the United States, right? United States is the safety because Europe's not in a good position right now, really not in a good position. And take all the problems we kind of cited here, make it worse, and then you have Europe, right? And in Europe, you have jurisdictions that are not sustainable. At least in the United States, we have a lot of jurisdictions that are sustaining themselves quite well. We have Florida, and despite everything, California is also sustaining itself quite well. They are having actually a surplus, right? So we don't have that domestic problem that Europe has. So think of United States as each state is a country, and Europe, the European Union, has many countries that together make up that economy. So the ECB, or the EU itself, has all these jurisdictions. So it's a little bit of a different system. But Italy itself, like Sven Carlin was pointing out, I do think is in a big problem. They're in a big problem, okay? And that might be it's a different story. And remember that we are discussing all of this with the presumption that United States, or the understanding that United States is the world reserve currency. So why is the dollar rising? Well, because the United States dollar is the de facto currency of the world in some sense, and the highest percent settlement transaction currency in the entire world. We've discussed this also in times when we talked about what's going on with Hong Kong, why is Hong Kong so important for China, etc. So when we kind of put that all together, we understand, okay, money's flowing into the United States. They're trying to buy United States pristine collateral. Pristine collateral, remember that word coming back? Well, it's coming back here. Pristine collateral. What is that pristine collateral? Well, that's treasuries. Treasuries are pristine collateral. Why? Well, we're in the US dollar system, the euro dollar system as a whole. You want that pristine collateral. Pristine collateral can be used to settle transactions among banks, right? You can settle that for collateral on whatever deal that you're going through. And it's the common currency that everyone has gotten behind globally, like it or not. That is the environment you live in. If that were to change, a lot of this stuff does in fact change. But for the foreseeable future, and by the way, it's a lot harder to get rid of the Eurodollar system than you might think, okay? I know China's trying, but you might think it's easy. It's very difficult, which is again why I would say to you the probabilities that a hyperinflationary crash occur at the present moment is not very likely. So that's actually one thing I'll leave you off with. It's not very likely unless some of these things change. And again, if they were to turn the Federal Reserve assets into currency, oh yeah, you bet yourself that they're going to do that. Because, like, for example, why would a bank does not, and I want to actually state this, a bank does not lend out its reserve assets. A bank does not do that. I'll actually show you something if you guys want some reading. I think this paper, if you guys are curious, is a 15-page paper. It's kind of a difficult read depending on what you think. I'm going to give you a synopsis or summary of it, but it's a good read. Repeat after me. Banks cannot and do not lend out reserves because they don't lend out reserves. Once you find out what reserves are, it makes sense. It's not money printing, okay? It's not money printing. And I know some of you guys think it's hilarious to, on the live streams, you try to troll me with money printing. But no, it's not money printing. I think money printing is a quick and dirty way of describing something and on which the common person can kind of get behind or kind of understand what is going on. But if you get down to the technicalities of it, no, it's not money printing. And you cannot lend out these things. These things are not lend outable because you cannot spend them. Okay, and all the Federal Reserve is doing is just doing an asset swap and taking on the liability, quote unquote, and exchanging that for a reserve asset. Well, they're technically taking out the asset from the bank, the commercial bank, and then they're giving them a reserve asset, and the reserve asset is redeemable at the Fed for those same liabilities or for that cash. And the reserve asset is a liability to the Fed, okay? But no money has been created in that transaction. It is simply an accounting move. That is all. And that's actually something that Jeff Snyder actually talks about with regarding when you get quote unquote Snyder pilled, that the Federal Reserve is in a lot of parts a psychological institution in how it tries to dramatically affect how people think. So if everyone believes that it has a certain power to do a certain thing, then it might actually impact behavior in such a way that things can move in the direction they desire. Okay, but when you kind of break it down and you start to learn and break up the Eurodollar banking system, you start to awaken to the fact that perhaps the Federal Reserve doesn't have as much control as you might think. Okay, so, but yeah, basically what you can get from this is, no, there isn't really going to be that hyperinflationary crash that people are thinking, because that's not really how it's working. In fact, you have a greater propensity or a greater chance of having rates come down a lot and having a Japan scenario. So Japan scenario, and by the way, that's not a good scenario. I just want to repeat to everyone, that's not a good scenario. That's a bad scenario. Like I just stated, GDP per capita is declining in Japan. So it's not that GDP is declining. GDP per capita is declining. So per person, it is coming down. You're effectively going to get, more than likely going to get poor. And the solutions to this that are described by Dr. Lazy Hunt, I won't say they're my solutions. I'm going to say they're his solutions, because he is the expert that I'm citing here, that government actually has to cut back on spending, has to actually reduce its borrowing. But the problem with that is, and we'll actually use Sven Carlin here for this. So where are you, Sven Carlin, with your chart that was really good for this? Here it is. So remember that equation of GDP, and I'll move it to the side here. So remember, we have government spending as a big portion of that calculation. So if we bring that down, hypothetically, to, let's say, half, how much would we be reducing the economy by? Quite a bit. However, over the long periods of time in this theory that we're discussing, or this understanding that we're discussing, it should actually show up in a positive manner, because the private sector should then be able to pick up some steam. Because we're crowding out the trade, okay? And now we're getting into the real meta. So I was trying my best to not go like absolutely insane all over the place. So I tried to keep it organized. That's why I think it's good if you guys, if you have any questions, ask. Or if I did a good job, let me know. I want to know if I did a good job of explaining this. But when the government is issuing all this debt, which is vital for the flow of things in the financial system, and that's again why it's always in the short term, right? I talked about this in Strongman's live stream, which a lot of people don't know this, right? The government does borrow a lot in the short term. It doesn't borrow in the long term. There are reasons as to why it does that. The government's not so stupid that it's just like, oh, I could borrow all of it on the 30-year and just owe a fixed rate of 3% for however many years, like a mortgage. Oh, the government could just take on a mortgage for all its liabilities. No, not so simple. I wish it was. I mean, what do you imagine? It would be, you just put all our solutions, just borrow all the money on that, and then we just pay it off. Not so simple, because the system relies on this on this liquidity of the treasuries. Okay, so banks want that. Okay, and again, what's government doing? Well, they're crowding out the trade. Banks don't want to put their money anywhere else. If you offer them a quote unquote risk-free asset where all the problem is on you, the government, okay? So basically it's like I'm the bank and you give me the 10 million. And I have, again, the 5% option or the 1% option. The 1% option is risk-free, or at least risk-free from a legal standpoint, because I can't get in trouble for doing that, right? Is the government really going to come after me for putting your money, right, your deposit into their debt? Really, we're going to have that. Let's have that conversation if someone believes that, right? The government's going to say, oh, you're putting it in an irresponsible asset. No, the government's not going to do that. So it's obviously in my self-interest to do that. And if I can generate any form of yield, well, it's on your money. I don't really care about the inflation. What do I care? Did you ever stop to think about that? What does the bank actually care about the inflation per se? It's not, okay, so it's a different scenario if, we have I'm loaning out my money, okay? If I'm loaning out my money, I care about inflation because it's my money. But if I use your money and I lend out your dollars, I don't really care about inflation in that scenario. I really don't. I could care less. If I make $20 off of your money and it takes me minimal effort, yeah, it's fine. I'm okay with that. So if everyone were to give me, let's say, $1 million, right? And inflation next year is 1,000,000%, right? If I made $1, right? And let's remove the equation of effort because I'm trying to be extreme on purpose. I made $1. Well, that's $1 I wouldn't otherwise had. And I took on no risk necessarily. As long as I give you back nominally what it is, and let's say hypothetically I put it into an instrument that will give me back exactly $1,001,001, right? I took on, in this instance, no risk. So that you understand, when you start to break that down, it makes sense why the banks love this, right? They are going to, and why they vote with their dollars, right? You want to pay attention to that. What are they doing with their dollars, everyone? Well, they're going out, they're like saying, okay, I have your money, and I'm going to use this because it's smaller. I have your money, and I'm going to put it into something. I'm going to lend it out as a mortgage. I'm going to lend it out as whatever. What am I going to buy? Well, as a bank, a lot of people think that banks, love yield. They just love yield. They just love the subprime stuff. No, those are the bad banks, right? Bad banks, no, they're not even going to be that good of an investment. They're only good investment during good times, but in bad times, they're not a good investment. So, and I know a lot of people in, I guess, the political crowd believe that banks are this mean monster that just wants to charge you the 20% interest rate on the credit card. No. In fact, if I was a bank, I would desire only the customers that are for sure going to pay me back on the credit card and just generate money on the money movement. Right? On that, when every time they swipe the card, I make that money. Because then if I could secure that many people that all pay me back, I lower the risk profile in my credit card business. The reason why that interest is so high is those who do engage in that behavior and don't pay it back immediately you have a risk factor that you have to apply. And the risk factor plus the interest, right, gives you a total expected value. Right? The expected value must remain positive because you cannot show a loss in that. A loss shows an inefficiency. So just as a profit is a measure of efficiency, a loss is a measure of inefficiency. And if you are too inefficient over a long period of time, well, you're out of business. Okay? That's all it is, right? So we kind of talked a lot about various different topics. But again, if you guys have any particular questions, I'd welcome anyone to come onto the live stream and ask further questions. You can ask the harder hitting questions, I guess, on the live stream as well. And remember, any kind of question is allowed. Again, I reserve the right to push off a question because the answer will be too long. Okay. If the answer is too long, I might desire to make a video about it because, I will be doing you a disservice if I answer it briefly because sometimes these topics are not something that you really get into. So the video is already at about 51 minutes. So I'm going to kind of cut it off here. We're just scratching the surface and I get really excited about this topic. If you can't tell, one thing I'll conclude, and you can see that this video was quasi response to Sven Carlin, but not really a response, but reaction. And mostly me ranting. So I'll say that I did enjoy his video. It's very entertaining. I think that he broke it down in a probably better way than I did, that someone who's just new could understand. Because again, I vehemently disagree with the term money printing. But again, I don't know what he thinks in his mind. He might actually think it's money printing, which I will love to have a conversation with him and disagree with him. Or he might be using that term because it's just a simple way and the media uses that word. So therefore, it's easier to the average person to just connect with that word. Okay. So I think in that sense, his video is much better suited for that. This video is probably not going to be well suited for that. Most of my videos are not, but I don't make an active effort to do so. I think that, and I responded to a comment more recently that said that the Sven Carlin video, for example, or not Sven Carlin, Joseph Carlson video was no value because it wasn't analysis, and which I responded. I tried to be, respectful and saying, well, it's not an analysis video, go figure. And, if you thought that he is an evidence-based investor, you should probably stick to watching his videos because I know my videos aren't for everyone. They're not going to be for everyone. And but I still enjoy, I just hit my mic there. I enjoy making videos, and that's about it. This is a side hobby for me. So on that note, guys, thank you guys so much for watching, and I will see you guys on the next one. Bye.